Our sweet spot are deals that make sense financially, regardless of whether it's an A or a B or a C. It's extremely hard to make A work today for us because we are in the business of the long-term hold. And if you look at some of these larger buildings, they are primarily built by what we call a merchant developer. They're leased up and then they're often sold. And today's game is cap rate compression. So if you build a building as a developer and you get a 5.5% return from the tenant's rent from the net operating income, you might be able to sell it for a 4.5 cap, which means you're making a 15% profit. And on a 30 or $40 million building, that's significant. You're talking about $7 or $8 million of profit. We're not looking to flip buildings after we lease them. We keep them when we lease them. So we look at cap rates and we look at the kind of returns that our investors want. Our investors are not interested in the same rates that pension funds are willing to take. They'll take a low return because they have to put a lot of money out. Our investors aren't putting a lot of money out. They're putting out 50,000, 100,000, $500,000, not tens of millions. So to fill up their pipeline, pension funds are willing to take a lower rate for a Class A building. I would rather, and most of our investors would rather, have a Class B building where we make an 8% return, getting 2% sent by ACH every quarter, as opposed to 1.25% or 1%. The returns matter. And so there's a market for both. In addition, there are many, many, many more tenants for smaller buildings than there are for larger buildings. If there are 20,000 tenants or tenants and owners in the Chicago area, and that's the approximate number, I would say that 17,000, 18,000 out of those 20,000 are in Class B buildings and are okay being in Class B buildings. They don't need the high ceilings. They're not Amazon. Amazon's the minority. They may lease 10 million square feet in a year, but in a billion square foot market, that's a very minuscule number. If I put a building on the market and it's 30,000 square feet and I can get an 8% return, my investors are happy and I'm happy because there are probably 6 tenants a year that will tour the building that can actually use it. Whereas in the larger spaces, you're lucky if you get 1 or 2, unless it's a year where Amazon is expanding wildly, which last year was. So those developers that did the high cube buildings and leased them to Amazon, by the way, they don't allow you to put a press release out that Amazon is your tenant. You have to say an undisclosed distribution company. So they're always something about the fact that they just don't want to be looked at like the monster that's growing everywhere. An undisclosed distribution company. In every press release, when you read that, that means Amazon. But our buildings attract a lot of local tenants, which is different. We take more risk with a local tenant than with a national tenant that has huge credit, that's a New York Stock Exchange operation. You can pretty much count on the rent being paid by them. With smaller tenants, there's more credit risk. There's a risk that they're entrepreneurs, they could lose a big account and they could end up in some financial trouble. So we have to have a risk adjusted return. We have to have a higher return for a higher risk level. And it's not as pretty. Our buildings are mostly nice looking, but they're not all perfect. There's some older bricks and some older doors and some big trees that aren't as healthy as they used to be. Our parking lot lasts about 10 years. Sometimes we're in the 7th or 8th year of a parking lot and it looks like there's some wear on it. That's fine, because for those deals, we'll make an 8 or 9% return. And we just can't do that with the Class A buildings. It's a different market.